Let me paint a relatable, well, a pretty painful picture for you right out of the gate.
Oh boy, I feel like I already know where this is going.
Right. So you wake up, you grab your morning coffee, you sit down at your computer, and you log into your brokerage account, and bam,
Just a total sea of red.
exactly, red numbers everywhere, just staring back at you. And we've all been there. You're looking at that one stock, maybe it was like a speculative tech play that you bought at $145 a share. And today, it is sitting at an agonizing $82.
Ouch. Yeah, that really hurts to even hear.
Your stomach drops,
Right.
and the natural human instinct, your instinct is to just immediately close the tab. You just want to pretend it doesn't exist, tell yourself, oh, it's a long-term investment, and just hope it rebounds so you don't have to face the music.
Which completely ruins the morning coffee, by the way.
Oh, absolutely ruins the coffee. And honestly, it just stings the ego.
Yeah, it is a very universal, visceral reaction. I mean,
Yeah.
nobody likes admitting they made a bad call, especially when your hard-earned money is on the line.
Definitely.
But, and this is what really stands out in the source material we're looking at today, there is a stark contrast in how different types of investors handle that exact same red screen.
Right.
According to the data, retail investors collectively leave billions of dollars on the table every single year in tax inefficiencies just because they just close the tap.
Yeah, just ignore it.
Exactly. But institutional investors,
Yeah.
the Wall Street professionals, they do the exact opposite. When they see red, they don't see a failure. They see a tax asset.
And that is exactly what we are focusing on for today's deep dive. We are unpacking a brilliant article from the Daily Fiscal, and it's titled, The Strategic Investor's Guide to Tax Loss Harvesting.
It's a great piece.
It really is. So our mission today is to perform a full-blown tax strategy audit for 2026. We're going to look at how the pros use this strategy, tax loss harvesting, to essentially turn that emotional damage into a tax asset. And more importantly, we want to figure out if it actually makes sense for you to use it in your own portfolio.
Right.
Because according to this source, middle-class investors are carrying thousands of dollars in unrealized losses while simultaneously writing checks to the government for capital gains. And as the article bluntly puts it, failing to use this strategy in a volatile market is functionally equivalent to tipping the IRS.
Tipping the IRS, that's a great line.
Right, and I don't know about you, but I am certainly not in the business of tipping the IRS.
Wait, but is this Wall Street strategy actually worth the time and the headache for the average retail investor?
That's the big question.
Because whenever we start talking about institutional tax strategies, we are usually looking at things that require, entire teams of accountants. I think it's crucial we look at whether this is practically applicable for you, the listener, or if it's just another hyper-complex financial maneuver that sounds great on paper but completely falls apart in practice.
Okay, let's unpack this because the mechanics are actually beautifully simple once you get past all the financial jargon.
Yeah.
I honestly learned a lot from how the article breaks this down.
Yeah, they made it very digestible.
They really did. The core concept is all about utilizing a paper loss as a mathematical shield. When you sell an investment for less than you paid for it, you realize a capital loss. And the IRS allows you to use these losses to offset your capital gains, dollar for dollar.
And it is categorized by the time horizon, correct?
Yes, that is a really crucial part of the math. Your short-term losses, meaning investments you held for less than a year, are used to offset your short-term gains first.
Which is huge.
It's incredibly valuable because short-term gains are taxed at your ordinary income rate, which is usually much higher. Then your long-term losses offset your long-term gains. So if you made a bunch of money selling one stock but lost money on another, you can just sell the loser to completely erase the tax bill on the winner.
Right. So if we connect this to the bigger picture, it's really about neutralizing your tax liabilities. But the source points out that it goes a step further than just offsetting your investment gains. What happens if the market is just having a terrible year and you don't have any gains to offset at all?
Ooh, that is where I get really excited about the math. Let's say you end the year with way more losses than gains. The IRS actually allows you to take up to $3,000 of those excess investment losses and apply them directly against your ordinary income.
Meaning your regular paycheck.
Exactly. We are talking about your W-2 salary, your 1099 freelance income, your everyday earnings. And why is that so powerful? Because ordinary income is taxed at your highest marginal rate.
I think we need to ground this in a real-world example, though. Throwing percentages around can get abstract pretty quickly for people.
Let's do it. Let's walk through the specific scenario the article provides with David.
Ah, yes, David from Chicago.
Right. So David is a 42-year-old engineer living in Chicago, making $114,800 a year. That puts him squarely in the 24% federal tax bracket. Now, back in 2024, David bought $10,000 of a speculative tech stock. Today, that stock has plummeted, and it's only worth $4,000.
Ouch. Okay, so he's sitting on a $6,000 paper loss. If he does nothing, he just has an ugly red line item in his portfolio and absolutely zero tax benefit.
Precisely. Now, let's say he clicks sell today. He actually takes that $6,000 loss. The IRS lets him take $3,000 of that loss and apply it directly against his normal engineering salary this current year.
Okay, and at his 24% marginal tax rate, deducting $3,000 from his taxable income saves him exactly $720 in actual hard cash on his federal tax return.
Bingo. $720 in his pocket. But he had a $6,000 loss, right? What about the other $3,000?
He carries it over.
Exactly.
Yeah.
The IRS lets him carry that forward to the next year, giving him another potential $720 in savings next April. So he turns a $6,000 mistake into a $1,440 potential tax refund. Plus, he now has that $4,000 in cash from the sale freed up to reinvest into a better opportunity.
I see, but we really need to pause here for a second and anchor this optimism. You're throwing around numbers like $1,440 in tax refunds, but it is critical that we are clear with the listener. These are absolutely not guaranteed tax savings.
Oh, for sure.
The math works out neatly in David's specific scenario because it's a textbook example, but everyone's financial situation is different.
I am so glad you flagged that. When I was reading that part of the article, I realized we are definitely not talking about a magical money printer here.
Yeah.
I want to be crystal clear with you, the listener. You should view this as potential optimization depending on individual tax brackets. It is a strategic tool, not a guarantee.
Hold on, let's look at the actual source material here, because it kind of throws cold water on this for a lot of people. This bracket caveat is huge.
It really is.
The benefits of tax loss harvesting diminish heavily if you are in the 10% or 12% tax brackets. The tax savings just don't mathematically justify the effort or the transaction costs.
That's a very fair point.
Furthermore, and this is the big one, this entire strategy is completely 100% useless in tax-sheltered accounts like an IRA or a 401k.
Right, because of the tax structure.
Exactly. Capital gains rules simply do not apply in those retirement accounts, so you cannot harvest losses there. You get no deduction for losing money in an IRA. This strategy only works in taxable brokerage accounts, and mathematically, the source suggests it really only makes sense for those earning over $50,000 a year.
It's an essential distinction. You cannot execute this in your retirement fund. It has to be that standard brokerage account where you were using after-tax dollars.
This raises an important question, though, because when I was reading this, my very first thought was, why not just sell the losing stock on a Monday to claim that sweet tax loss, and then, because I still believe in the company long term, just buy that exact same stock back on Tuesday at the new lower price?
I actually thought the exact same thing. I figured, hey, I'll just buy it back the next day at a discount and ride the recovery. But the article explicitly warns about an IRS trap where retail investors get absolutely slaughtered. It's called the wash sale rule.
So you can't just treat the stock market like a retail store, where you return a sweater you shrank in the wash and immediately buy the same one off the rack to get a discount.
That is the perfect way to picture it, unfortunately. Under Section 1091 of the tax code, if you sell a security at a loss and buy a substantially identical stock or option within a strict 30-day window, and that means 30 days before or 30 days after the sale, the loss is entirely disallowed, denied.
Wow. Just completely wiped out.
Completely. The IRS will completely block your deduction for the year, and they just add that loss back into the cost basis of your new purchase. You get zero tax benefit this year.
And for anyone thinking they can just fly under the radar, the source makes it clear. The IRS tracks this automatically. Your brokerage sends them a 1099-B form at the end of the year. The wash sales are mathematically flagged right there on the document. There is no hiding it.
Nope, none at all.
But that creates a massive dilemma for the investor. If I sell a stock to harvest the loss, I am forced to sit in cash for 32 days to safely clear that wash sale window. If the market suddenly rallies during that month, I completely miss out on the gains. I might save a few $100 on taxes, but miss out on thousands in a market recovery. How did the professionals handle that risk without sitting on the sidelines?
Here's where it gets really interesting. They use something called the proxy asset playbook. A proxy asset is an investment that behaves very similarly to the one you just sold. which keeps your money riding the market waves, but it is not legally defined as substantially identical by the IRS.
Let's break that down with an example, because substantially identical sounds like a phrase corporate tax lawyers love to argue about in court.
It really does. Let's look at what the article calls the S&P 500 swap. Let's say you hold an ETF, an exchange-traded fund, which is basically just a basket of stocks that tracks the S&P 500. For instance, the Vanguard S&P 500 ETF, ticker symbol VOO.
Okay, tracking.
And let's say you are holding it at a heavy loss. You cannot sell VOO and immediately buy the SPDR S&P 500 ETF, ticker SPYY. Why? Because they both track the exact same underlying index of 500 companies. The IRS usually considers that a wash sale.
Okay, so you can't just swap one brand name for another if the product inside the box is identical.
Wait, let me rephrase. You hit the nail on the head. The professional play is to sell VOO, harvest your tax loss, and immediately buy the Vanguard Total Stock Market ETF, ticker VTI.
Ah, I see the difference.
Right. VTI tracks 4,000 stocks instead of just 500. It behaves 99% identically to the S&P 500 over time, so your money is still growing if the broader market recovers. But legally, it is a distinctly different asset class. You hold VTI for 31 days to clear the window, and then you can safely swap back to VOO if you want to.
That's a clever workaround for index investors. But what if you are picking individual stocks? The source mentions a competitor swap, which I find really intriguing.
Well, that's a great one.
Let's say you bought Home Depot at $360, and it's plummeted to $280. You still firmly believe the home improvement sector is going to bounce back, but you want to capture that $80 per share tax loss right now.
Makes sense.
You sell Home Depot, harvest the loss, and you immediately use that cash to buy Lowe's. You maintain your exact same exposure to the home improvement sector, but because Home Depot and Lowe's are entirely distinct corporate entities, the IRS allows the loss. It's perfectly legal.
It's literally in the rule book. Wealthy investors use these proxy plays every December to engineer their tax bills down to the absolute baseline without ever actually pulling their money out of the market.
Okay, I love the Lowe's workaround, but let me play this out in my real life. If I have a portfolio of 20 different stocks or funds, I'm suddenly tracking 31-day windows on a spreadsheet for every single one.
It gets complicated.
Right. I'm hunting down legally compliant proxy assets for different sectors, making sure I don't accidentally buy back too early. But tracking 31-day calendars, finding proxy ETFs, this sounds like exactly the kind of administrative friction that makes 80% of people say, you know what, I'll just do it next year. And of course, they never do. It sounds absolutely exhausting.
I completely agree, and that is exactly why the financial tech industry stepped in. If you are a die-hard DIY investor, logging in once a year in December to do this manually is valid. But the massive trend among high-income professionals right now is using automated robo-advisors. Platforms like Wealthfront and Betterment have built these incredibly sophisticated algorithmic tax loss harvesting engines directly into their software.
But how does that eliminate the friction I just described?
It takes you entirely out of the equation. Instead of you logging in once a year with a stressful spreadsheet, the software is monitoring your portfolio every single trading day. Let's say it's just a random Tuesday in August. One of your international ETFs drops below its purchase price and hits a certain loss threshold. The algorithm instantly detects it, automatically sells it to harvest the loss for your tax return, instantaneously buys a heavily vetted proxy ETF so you never lose market exposure, like selling VSUS to buy IXUS, and then it seamlessly swaps you back 32 days later. All of this is happening in the background at machine speed while you are sitting in a Zoom meeting. You literally do nothing.
The convenience factor is undeniable, I will give you that. But as always, we have to talk about the cost. Robo-advisors aren't running these complex daily algorithms out of the goodness of their hearts.
Obviously not.
They typically charge an assets under management fee, usually around 0.25%. That's $25 a year for every $10,000 you've invested. Generally, I am a fierce opponent of AUM fees. I almost always advocate for buying traditional low-cost index funds where the fees are rock bottom, like 0.03%, and just ignoring the noise.
I know you hate fees. We've talked about this before.
I really do. Because over a 30-year investing horizon, giving up 0.25% every single year doesn't just cost you the fee itself, it costs you the compound growth on that money. It compounds into tens of thousands of dollars lost over a lifetime. Does the tax benefit actually justify bleeding out that much in management fees?
That is the ultimate question. And the author of this article actually agrees with your philosophy on keeping fees as low as humanly possible. But they present some incredibly compelling data, showing that automated tax loss harvesting is one of the rare exceptions to that rule.
Oh, really?
Yeah. For investors in the 24%, 32%, or 35% tax brackets who are consistently pushing regular cash deposits into their taxable accounts, the math swings heavily in their favor. The source notes that the tax efficiency generated by this daily automated harvesting frequently exceeds that 0.25% fee by a margin of 3 to 1 or more.
That is a substantial margin. If the math checks out, paying 0.25% to save 0.75% is a trade I'd make. But I know we have listeners who absolutely refuse to pay management fees of any kind. They're going to want to execute this themselves for 2026.
And more power to them.
Exactly. But if you are going the DIY manual route, there are some incredibly strict warnings in this guide that you cannot ignore. First, do not wait until December 30th to do your harvesting.
Yes, the timing is critical.
Brokerages operate on settlement times. Currently, that's T+1 in the U.S. markets, meaning trade date plus 1 business day. When you click sell, it takes 1 full business day for the actual ownership of the stock to transfer and the cash to officially settle in your account. If you execute a trade on New Year's Eve, it might not settle until January, which means the tax loss hits next year's return, completely ruining your strategy for the current year.
And the second major warning for the DIY crowd is about identifying your specific shares. You need to use the specific ID cost basis method when you sell. Let's say you own a lot of Apple stock. Overall, looking at your dashboard, you might be up $5,000 on your Apple investment. But maybe you bought a specific batch of shares last April when the price spiked, and those specific shares are currently down $800. You don't sell your whole Apple position. You instruct your brokerage to sell only those specific shares from April.
You surgically extract the loss without triggering a massive capital gains tax on your older, profitable shares. That requires paying attention to the details. And that brings us to the third, and frankly most dangerous trap for the DIY investor, the DDRIPE danger. DDRIPE stands for Dividend Reinvestment Plan.
This one blew my mind.
It's brutal. Let's say you just sold 100 shares of a dividend-paying stock to harvest a big loss, but you forgot you had your DRP turned on. 2 weeks later, right in the middle of your 30-day waiting period, the company pays out a tiny $4 dividend. Your brokerage account, doing what you previously told it to do, automatically uses that $4 to buy a fraction of a share of that same company. Boom!
Wow.
You just bought a substantially identical asset during the 30-day window. You triggered a wash sale. A $4 automated purchase can instantly nuke a $3,000 tax deduction.
Nuke is the right word for it. That is a brutal technicality that I guarantee catches thousands of people off guard every single year. So what does this all mean if we synthesize everything we've looked at in this deep dive? It fundamentally shifts how you should view a down market. Stop treating market downturns purely as emotional damage. High net worth individuals don't panic when they see red numbers. They view those red numbers as tax currency. They harvest the loss. They use it to offset up to $3,000 of ordinary income. They carefully reinvest in a proxy asset to stay in the market, and they just keep rolling.
The ultimate takeaway for you, the listener, is this. If you have a taxable brokerage account, remember, not your IRA, and you earn more than $50,000 a year, leaving thousands of dollars in unrealized losses sitting idle on your screen is essentially financial malpractice. You are effectively choosing to pay a higher tax rate than the law requires.
So true.
But please, hear the caution loud and clear. Consult your CPA, verify your specific tax bracket, and ensure the math makes sense for your personal situation. This is about strategic optimization, not a magical money loophole.
A perfect summary. And before we wrap up, I want to leave you with a final provocative thought to mull over, something that wasn't directly addressed in the article, but builds on everything we've discussed today. We talked about how robo-advisors are automating this entire process.
Yeah, the algorithm's doing it all in the background.
Right. If platforms like Wealthfront and Betterment continue to grow, you suddenly have algorithms programmed to instantaneously sell billions of dollars of ETFs across hundreds of thousands of portfolios the exact moment the market drops, just to harvest those tax losses.
It's a fascinating systemic risk to consider. If algorithms are programmed to instantaneously sell billions of dollars the moment the market drops, could this massive, synchronized, machine-speed selling actually amplify market volatility and cause the very market dips they are trying to take advantage of? Are the tax algorithms going to cause the next flash crash?
It really makes you wonder who is actually driving the market, the humans or the tax algorithms. Thank you so much for joining us on this deep dive. We hope it helps you look at your portfolio in a whole new light. Until next time, keep optimizing, and we will catch you on the next one.